Thanks for joining us today. We're going to kick things off. Today, we are going over some of the strategy and things that are impacting not only our business as a whole, but real estate, talking about what we're seeing in the market and what we're doing about it. So we're going to start off. Our first thing that we really want to get into right now is the private debt and banking market and kind of where things are at right now that we're seeing in our portfolio.
Yeah, banks really started tightening up their relationships. Not really lending, but more their relationships like 2-3 years ago. We really saw this trend. And so we're talking with one of our banks that we've done a bunch of business with, and there was a lot of consolidation going on. As there's less banks, there's less competition, so there's less new friends to go make. And we were talking with one of our bankers, and we worked over 10 years, and she was out looking for a new opportunity, and she was telling us really all what we already knew and what we were seeing. And we really came together and said, why don't you come on board and help strengthen our relationships with banks and build a pipeline of future lenders. So that's really been kind of 3 years in the making. That's really put us in a very different position than a lot of our competition, enabling us to be more aggressive on purchases, to execute on purchases. This hub deal is a great example, right? It's like we've been chasing it for 9 months. We've held firm on our price. We were 4th, maybe 5th place in terms of highest price offer. And after 4 other groups fell apart because they couldn't get a bank loan, they came back to us. We held firm, and now we're on track to close in about 2 weeks.
Yeah, that's definitely a good example of it too. And bank lending, it hasn't necessarily gone away, but most banks are just working with the existing relationships they have. So they're focused on who have they done business with, who do they know. They're nervous on the other side too. Like, right, they need a borrower that's gonna make all their payments. That's gonna execute a business plan successfully, and they're relying on their existing kind of pool of customers to get that done.
So my latest conversation with one of our mortgage bankers was her favorites are when the person who's never done a piece of commercial real estate ever, they never purchased anything in their entire life, and they come to her and say, "Hey, I want $1 million loan, and I've never done this before." And she said that's her favorite, and it was sort of
it's her
comical.
favorite to work with.
It's her favorite to work with, yeah. And she just says, she shakes her head, says, "I don't know what to do anymore when that happens." And so we are a lot more easier for her to deal with than that person who's never done it before.
Kind of the hybrid approach is that we were working with mortgage brokers in this interim, and we were working with 2 or 3 mortgage brokers, and they're great. And there's no criticism of mortgage brokers; they do great work. But at times, their pool and their relationships are not strong enough, and they need the borrower to have that direct relationship in order to execute the loan. So that's when we moved to kind of the in-house model.
Yeah, and that's been working for us. But so that part of the bank world where it is still tighter, I don't think a 0.5-point interest rate swing is going to move the needle on that strategy with banks of how they're executing their business. So there's definitely still a longer runway of a tighter bank environment. And in the meantime, that's opened up a lot of the private debt market, which is higher interest rate private loans. We've done a few of these. We're looking at doing more of these. And that's a whole array of opportunity that comes in there and how those are structured. So we've done ones that are essentially providing capital and taking a lien on the property. We've done other ones where we're providing capital, but we're simply taking a personal guarantee on their general performance, not tied to a specific, it was for a specific asset, but the guarantee of it was just a personal guarantee based on the business as a whole. And then we've done other ones that are based on a business guarantee. So there's lots of different ways you could look at. It's typically called like hard money lending,
right?
And there's a lot of different ways that plays.
But hard money also has a different type of risk profile. But honestly, if you come to me as an investor, to me it's a very simple. It's math of I'm going to earn 7.5 or 10% on an investment where I could own the first 20% of a piece of real estate. And that's a lot different than owning like a 65% loan or being preferred equity inside of a deal too. But honestly, if someone's going to pay me 7.5% and my 7.5% is going to be reliable for 10 years, to me that's appetizing, especially if the risk profile is like it's minute.
Yeah, it varies a lot. And typically the private part of it outside of the bank is going to be faster. Doesn't necessarily mean faster isn't always better. Odd for me to say that, but faster. isn't always better. But I mean, banks, like, they do a lot of underwriting when they're going into a position, and they understand a lot about what's happening. So there's definitely value in that. Like they know what's going on a lot.
And our focus is really, people are in our network, sponsors that we know, businesses that we know, and working directly with them. We're not really looking to cast this wide net, go national, and lend to anyone that applies. It's really, let's keep it simple. Let's stay in kind of our universe. We're lending to a property that we're selling, so we're basically doing seller's financing back to them. Some of the other ones were business relationships that we've already had for years. The other opportunity is really buying notes off of banks' books. So we did that. We actually bought some notes off of companies' books at a deep discount that provided, just excess yield for us. So it was excellent.
Provided them capital when they need it and excess yield for us. But yeah, that's all. In our strategy, it's all relationship driven. So we're not going out and doing like a mountain of cold calls to place hard money with people we don't know. And we're not raising a fund to go deploy money all over the country. That's not our strategy or our really approach to business at Greenleaf. So we're just using the relationships we have, people within our network that we can work with, and seeing what opportunities are there for alternative capital structure to take down a deal.
Yep.
So, yeah. But again, there's talk end of 2024 that interest rates are going to drop a little bit, and there's definitely a sense of excitement around that. I don't think that's really going to change much on the bank lending velocity or flow of funds that are going to happen because of that, though.
Yeah, I think it'll lower our government's cost of capital on the loans our government has.
Yeah.
I think it will lower some of the carrying costs on variable costs of capital. But I don't think it's actually going to open up the floodgates for lenders to just go back into the market.
Yes. Agree, yeah. Cool. But yeah, we definitely see a lot of potential opportunities in the private, debt, capital, lending realm, and we expect that to be there for at least another 12 months as we look through these. So we plan to have a few more deals that'll come out. We'd have different stuff on when we do take a deal out, but yeah, we're definitely seeing opportunities that are there for that. Mm-hmm. I think it continues for at least another year.
Right. And the other thing that'd be interesting, and we'll take a deal out like this, in the next 30 days or so, is that as we have 1031 money, a significant part of 1031s is you also have to place the debt. So let's just say you sell a deal for $1 million, $700,000 of it was debt, $300,000 of that is equity. You don't only have to place the $300,000, you also have to place the $700,000. So we have a 1031 right now that has a decent amount of debt that needs to be placed with it, and lenders are really tight on lending. So we're looking at basically raising an internal debt vehicle to solve that problem.
Yeah, and that's we're looking at on the retail side too.
Yep.
Because basically a 1031, you have to keep your same debt to equity ratio for that to stay, or you're going to trigger some tax liability within that vehicle, right? Cool. So taxes, we always like talking about taxes, but property taxes, specifically here in Georgia, is something we have always covered, and we're always like trying to manage tax liabilities. There's not much you can do on the property tax side, but you can appeal your property tax valuations.
Well, taxes are our number one expense throughout the entire portfolio.
Correct.
Yes.
Yep.
So
yeah, property taxes are our largest expense that we have. And in Georgia, and in all of our states, we can appeal what's called the assessed value of the property taxes. So if the state or the municipality says it's worth $5 million, and you can appeal and say, hey, it's actually only worth $4 million, you're trying to come to some negotiation there. There's a lot of time and effort on both sides, on our side, on the state, the municipality side, spent on doing that conversation. Really jump through the hoops of figuring out what it is. But Georgia, they just passed a new Senate bill here, Senate Bill 349. 340, yeah. And Josh, you're like, wow.
Yeah, whatever it is. What are the numbers?
it's 349.
It's Senate
ABC.
Bill 349. But it doesn't impact the commercial buildings, but it does on the residential side, and it limits the rate of acceleration of the assessments on your home.
Which doesn't mean your taxes don't go up.
It's one of the pieces.
It's one of the pieces, right? Because there's three pieces that we were talking about before.
All right, so remember, the three pieces are?
You have the millage rate.
Okay, which is
the
really the percentage of the assessed value.
Right, and then you have the assessed value of how
Yep.
does the assessed value get moved up and down. And then we call it the levy, which is the state says this is the maximum number, this is the max dollar amount that you could raise and or have on your digest for the year.
Okay.
So the most you can collect.
The most you can collect,
So
yeah.
you've got those three aspects. Every state does it a little differently, which is fine, right? Each state can do it how they choose to do it.
What we tend to see, though, is like states that have either, say, no state income tax or low property taxes, they'll throw in taxes somewhere else. So net, it ends up being the same.
Well, my favorite discussion is Florida. And Florida
Right, Florida's a great
advertises,
example.
No income taxes, no income taxes. But what does that mean? It means property taxes are higher. And
That's the same way.
I have a piece of property in Florida, and the property taxes they're incredible. They're absolutely incredible.
So 349 here in Georgia is going to cap your assessed value on a residential home at 3% growth per year.
Right, which means your millage rate or your
Well, millage
millage rate
rates,
can go up and still increase your taxes. And then,
but millage rates in Georgia, millage rates also have a cap. So there is a cap on how much they can go up there, but there's not a cap on overall tax revenue that the state can take in. So
right,
yeah.
we'll see what happens.
Yeah, but it only affects the residential side. We've talked a lot about our property tax rates on the commercial side. This isn't going to do anything for those caps. There's still no caps on medical office building you own. They're going to charge.
Well, somehow between I had an appeal on my personal residence tax, and whatever the timing was, my taxes went up from this year to the year before. From 2023 to 2024, they went up almost 50%. And it was something with, I appealed, and the appeal didn't come through, but then they raised the taxes. But to me, what this means is we're going to have a reliable 3% increase in our property taxes every year for a long time.
On the residential side, though.
On the residential,
So,
right.
Concern I would have is the states and cities. I mean, the budgets keep growing, and they need more money in the door to meet their needs or what they want to spend it on, whether we agree with it or not. Does that just put more pressure on the commercial assets having higher tax rates?
Well, I mean, the city governments need a certain amount of money to run. I mean, they have a tax digest, and they just have a certain operating expenses, just like they're an organization that has expenses, and their expenses are going to increase every year. Their payroll is going to increase every year. And if their revenue doesn't increase, something has to
Yeah, they're going to get it from somewhere. So
Yeah.
the only concern is that they're just then going to take that out of the residential pool and push that to the commercial property tax pool. So.
Which leads us into our next discussion, because if they're going to charge the commercial property owners a lot more. It's going to push.
Put pressure on rents.
It's going to push on rents, commercial and residential.
Yeah.
And
So but I think that's good for residents and residents of Georgia. I think that's a good thing, but we'll see how it goes.
Right.
All the states kind of have it all in a different manner, but you're really paying. You're paying it somewhere, just kind of like, how do you want to pay it?
right. Well, these two topics are focusing on residential. I mean, they're focusing on the actual living of a person, not a commercial space or a business space or a restaurant. So they're focusing on where that person actually lives.
The voter.
The voter.
Yeah, the
whether it's
voter.
in a house or an apartment. So yeah, the voter.
Yep.
Good one there.
Yeah, the next one we want to talk about that we've gotten some questions on and we've heard about, and it's definitely in its infancy, but there is this kind of quick discussion of, hey, 5% rent cap on rent growth each year, and somehow that was going to be implemented across the country, and it was fairly popular. It's like, wait a minute here, how is that actually going to be done? And if you do not comply, you're going to lose some accelerated depreciation. There's not a whole lot of detail of kind of where that stands, but it definitely seems like it was a growing. There's some steam behind, like, hey, we're going to push this through somehow.
Go ahead and say it. I know you want to say it. Government mucking with the free marketplace.
On the federal basis, government getting a little maybe too involved there.
Right.
But it also sounds like one of those things where the government would try and do one thing, and then like 700 other items would get packaged with this bill, and it would be like forever long, and people are like, what's even being voted on anymore? We're not even sure.
Yeah, and I would say they do one thing, and then that one thing has an impact in all these different areas, which are like when they were talking about 1031s every tax season or every time.
Yeah,
they talk about 1031s.
Is the 1031 exchange going to go away on the federal basis?
I mean, for us, the three of us personally, I mean, changing whether 1031 works would devalue like almost every single property we own and would change the valuation of how properties are in the U.S. And it would be a big deal.
It would trigger a lot of taxes. 1031s are essentially pent-up taxes that the government will eventually get at some point.
Right.
So,
And
so
so
like, do you want to realize that revenue now? Or from a government standpoint, do you want to get that? How do you want to do it?
In theory, 1031 taxes, I mean, the government will not always realize them because once, well, we all know that once you die, there's some benefit to your spouses because your basis goes away in the 1031 property. And so the government won't realize the tax benefit of that 1031. But I mean, I think that if they actually did muck with the 1031 laws, I think real estate in general across the board would be devalued. That's my perspective.
Yeah. But on this 5% cap, the what was kind of spread around was that they're going to limit the amount you can increase rents 5% a year. And if you do not do that, you would lose some of the accelerated depreciation rules in real estate. And right now, since the tax policy change happened in 2017, that's when depreciation, anything shorter than 15 years could just be accelerated and depreciated now. So lots of real estate transactions, you'd take the pieces that were 15-year depreciation and you'd write those off right now. So you got those in year one. So all of that kind of depreciation has already been used, I would say, on most deals that were purchased between 2017 and now in 2024.
And so to me, then there's more math you have to do at when you're running your property. Am I going to take the 5% rent cap, or am I going to take the accelerated depreciation? And then it becomes a math puzzle of which one's more beneficial. And
and it was only for owners that have more than 50 units. So once you're kind of over 50 units too, you're looking at all.
There's a lot of other moving parts.
There's a lot of moving parts in how you're figuring out, like, what does your year-end tax situation look like? So it just added another puzzle piece to that. And if you're under 50 units, it was not applicable. So for most, it's kind of like for most people, that's not going to have it's not going to be something there. There's a huge amount of real estate that is individuals that have a rental house or they bought a condo and they moved out and bought a house or something and they still rent out that condo. That's a lot of what the rental market is out there, and they wouldn't be impacted by it.
Right. Now, also, there's a lot of other great government programs out there to help somewhat offset or accomplish the same thing. With housing vouchers, and we have residents coming and paying their rent in lots of different ways that are getting funding from many different places. A lot of that's the federal government being funneled through counties and cities and nonprofits, et cetera. My personal take is that there's already these great programs out there. Why don't we just keep funneling money through the programs already established instead of trying to mess with a free market economy?
Or creating a new, it's almost
creating
like creating a new rule or a new law or a new entity that's got to go manage how this is going to be tracked. Unless it's just like part of the IRS code. It's like you're kind of making new things when there's plenty of things that exist that could probably just use more of them if that was deemed necessary.
put your resources there versus here.
Because even, when we look at our housing vouchers that we receive from some of our residents, those rates are published through a platform called, it's through Edgar, and it's like HUD User, which has all the rental rates, basically studio through 4 bedrooms in every municipality in the whole country, and it has what the average rents are and what the reimbursements are, and they're set by the government for those, but they're based on market rents, and they go up and down, and they're highly variable, and they go up and down more than 5% in different ways each year. So I don't know if they would restrict their own thing.
Right.
It's weird, or they could just do it through that program as well.
Right. I mean, and there's already government programs for new construction. If you want to build and restrict your rental limits, the government basically fully finance a deal for you. And it's basically accomplishing the same thing there, just do more of that instead of kind of spreading out to the whole market.
Yeah, so it sounds like it was a good news piece. I don't necessarily know if anything's going to happen with it. For us, we would just be looking at something like that as a change in tax law that we have to manage when we are going through and operating our deals as efficiently as possible from a tax standpoint. We would just look at it from that angle. We have not had rental rate growth lower than 5% in 6-7 years. Really, it's been a long time since rental rate growth was lower than 5%. So that would obviously have an impact if they're saying, okay, now it's capped at 5%. But go back to our kind of earlier point, if property taxes are free floating and going up and you cap revenue, it's going to put some challenges or stress in the real estate market as a whole. So there's that concern to it. But generally speaking, the accelerated depreciation laws have only been in place for the past couple of years. So it would just go back to how it was before that.
Exactly.
Which was fine at that point as well.
Right. Yep.
All right. That's what we've got for today. Hope this is helpful. Give you a little insight on what we're seeing in the market and how it impacts our portfolio and what decisions we're making. So thanks for watching. Let us know if you have any questions.